and welcome to Hardman Talks. I'm Larissa Adams, and today we're joined by Richard Angus, our Head of Business Development at Hardman Co. And we're going to discuss the really critical topic of room risk in private company valuations. So room risk is a really nice little acronym for running out of money, and it's become increasingly important in today's business landscape, especially given the economic challenges that many companies are facing today. So Richard, welcome. It's great to have you.
Larissa, it's great to be here.
Okay, great. So let's start with the basics. What exactly is room risk? Tell us a bit more about it, and why is it so significant in the current business environment?
Okay, so room risk is a way of assessing a company's ability to sustain itself financially while pursuing its growth goals. In a sense, it's a contributor to valuation assessments and goes far beyond the going concern commentary in corporate accounts. Now, no one can say they don't understand the terminology room risk, and it's very important in today's markets for matters that we will point out. In many cases, it's clear future funding will be needed, and this is expected. But if things don't go to plan, there may be a tendency for management to ignore the issue or only address it when it's too late. It may well be a false assumption to believe that existing shareholders will step up to the plate or banks will be accommodating if a problem does emerge. Now, specific corporate issues or changes in the funding landscape cannot be ignored. While I can understand the reluctance of boards and existing shareholders to resist overcapitalizing a business, the fact is it's a risky strategy, and particularly now because the key magic phrase is cash is king. So a company that runs out of money is likely to destroy any value previously created. Now, if you look at the UK, we have tremendous entrepreneurial talent, but this ambition needs to be financed on an ongoing basis until companies reach a point of self-sustainability, in which case they are in control of raising funding in the future. But we're not talking about that today. So today, risk assessment is absolutely critical. And rather than focus on the growth opportunity presented to investors to get their support, under a room risk assessment, a business is scrutinized for its ability to handle disappointing progress.
So Richard, just for the sake of investors, I guess would it make sense to say room risk is the assessment that provides almost a survivability sense check that increases their understanding and confidence rather than living in ignorance or fear. I think it evaluates the risk of a business running out of cash before it reaches profitability or secures further funding, and should reflect a director's awareness of that risk. Is that right to say?
Yeah, that's absolutely right. I mean, times when the economy is buoyant, little thought is ever given to future funding needs. It's almost a given that money will be available when required, and normally at a higher valuation than today. The focus is entirely on the opportunity, and the balance sheet and access to liquidity receives relatively little attention. But in today's climate, with the economy trying to recover from COVID, international issues, there are certain higher risks of financial exhaustion. This has not gone unrecognized by investors. And if you look at the public markets, for example, it's not too difficult to see companies that previously were rated with high potential within a very short period of time are now being valued for relatively negligible amounts. And the fact is because people are worried that they are actually going to run out of money. In other words, they're priced to fail.
Yeah. So, clearly room risk has become more relevant now. So how are current economic conditions increasing the likelihood of businesses actually running out of money?
Well, there is anyone who has ever run a business will tell you that nothing goes up in a straight line despite having robust business plans. And setbacks can be caused by a number of things, possibly outside your control, and maybe you have unexpected internal issues. But the rate of growth of a company, therefore, might be impaired, or there may be even bigger fundamental issues that weren't thought of at the time. But the point is, this is likely to be reflected in lower cash generation and then liquidity pressures, neither of which are good for overall confidence nor for valuations. While this obviously impacts management's ability to meet previous articulated goals, it may well divert investors' attention away from growth potential towards shorter-term concerns about the viability and sustainability of a business. And that's exactly why room risk is an important element. But don't take my word for it. 52% more businesses in the UK went bust over the last 2 years. And I think 140,000 businesses were debanked last year in the UK. So there is empirical evidence to support what we've just been talking about. So we have a situation where investors can see that many companies facing operational pressure will end up with financial pressures as well. And access to funding may be constrained by risk-averse banks, and investors have already experienced a number of problems themselves and disappointment, and that could easily dissuade them from adding more capital risk to their portfolio. So without a clear and process, I think, would think to assess financial risk, businesses may fail simply because they can't access the funds and because their shareholders don't understand the extent of the problem.
Okay, so I think what you were saying about companies going bust and the high number that's happening these days is just incredibly alarming. So how do you see room risk impacting the way investors allocate capital in this difficult economy?
Well, I think what investors are seeing is that when things start to go wrong, they can deteriorate very rapidly. And if you're involved and invested in a business where the management has an attitude that we're different, we're better, etc., or display an element of arrogance, it's probably not the right approach in this sort of market. So you have to have, as a board, a plan B to survive unexpected financial pressures. Now, the issue is that many shareholders and potential investors don't have the means to carry out their own risk assessment. And they are only enlightened about problems once they have happened, and that's basically too late. In other words, by this time, the fair value of the business has fallen materially. So, who wants to catch a falling knife? Therefore, if a valuation doesn't factor in the likelihood of a company running out of money, it might appear attractive on paper, but in reality, it's potentially headed for trouble. And private company valuations must now reflect a far more cautious approach, incorporating room risk to ensure that investors are seeing a fair value assessment and can make the appropriate judgment.
Okay. And what about the process and what actually goes into this room risk assessment? How do you go about assessing room risk when valuing a private company?
So when we assess room risk, there are several critical factors to consider. And primarily, we're looking at the specifics of the business. And we also take into consideration certain macroeconomic factors. But we are, in essence, putting ourselves in the shoes of experienced investors and other providers of finance and forming our own judgment. So first, we need to have a clear understanding of the company's aims and the robustness of its business plans. Then we examine the company's cash reserves, its burn rate, how quickly they're spending their available funds. This involves understanding the company's cash flow assumptions and potential funding gaps. And then the third stage is that we undertake a number of stress tests looking at key variables such as the impact of lower revenues, higher costs, etc. And this involves stress testing the cash flow assumptions and considering how long a company can realistically survive without additional capital. Now, in addition, we do a certain amount of modeling. So we might take, for example, a 3-year business plan from a company, and we might model it over 4 years to see what the impact would be on the business and whether the survivability is a problem or not. So we evaluate the likelihood of secure future funding, which is often influenced by market conditions, by investor appetite, and the company's strong relationships with its shareholders, if it does have any. And then remember, of course, we look at debt funding, which some people forget about. But if your debt doesn't roll at its maturity, you have a problem. And there have been cases in the paper recently of many companies finding that their debt hasn't been rolled when they expected, and it's put them essentially out of business.
Yeah. There's a lot that goes into it, and I think it's important for investors to really understand all the elements and components of this room risk assessment. Yeah. Great. So I guess, are there any specific sectors or types of businesses that are more susceptible to room risk, and how should investors actually approach these companies?
Well, yes, there are certain sectors are inherently more susceptible to room risk, particularly those in the capital intensive areas such as technology startups, life science firms, renewable energy companies. These businesses often have long development timelines, and they won't reach profitability for some time. So meanwhile, they're relying very heavily on the ongoing external funding. Now, in times of economic optimism, as we've said, both companies and shareholders focus on growth rates to generate the current market value. You can see this clearly in the public markets, and especially when IPOs are hot. So these companies are priced for success. Although the private sector lacks the liquidity provided by public markets, we are of the opinion that overall sentiment remains consistent in this basis. But confidence and sentiment can change dramatically, and this is a key point. And today, for reasons that are self-evident, investors approach these sectors with a greater degree of scrutiny, particularly around cash flow and funding strategies. And if management aren't able to address these issues with convincing degrees of credibility, then investors are not going to be accommodating. The key is to understand how much runway companies have left and whether there are clear plans in place to secure the next round of capital if it's needed, or indeed what its emergency funding plans are.
Thanks, Richard. I'm sure that's going to be sound advice for a lot of companies watching this. So what advice would you give for business owners or CEOs who are concerned about their company's room risk, and how can they manage that proactively?
So I think the key piece of advice is to business owners and to the CEOs is be proactive and realistic in your assessment of the business and in the way you communicate with investors. So first, assess your cash flow and ensure that you have a clear understanding of your burn rate, know exactly how long current funds will last, and plan for potential funding gaps in advance. But secondly, build strong relationships with your investors and lenders. Open communication can help when you're securing funding, make it much easier if they feel happy and confident in what you're doing. And lastly, you should do your own stress tests of your financial models under various scenarios, including worst case outcomes, just so you can be better prepared for any bumps in the road and adapt more quickly to changes in market conditions. So to repeat, basically, cash is king.
Cash is king. We couldn't.
Cash is king. That's the key takeaway from today's talk.
Definitely. All right. Thank you so much, Richard. I think it's been really valuable and a great insight into room risk and how it affects private company valuations. I think it's clear that businesses and investors need to be more aware of these financial challenges, especially in today's environment. So thanks again.
Thank you, Larissa. It's been great to discuss this matter with you, and I look forward to continuing our dialogue in the future.
Yeah, of course. And thank you to our viewers for watching this episode of Hardman Talks. Please do hit the like button and subscribe to our channel. Let us know your thoughts and drop us comments in the box below. We'd love to hear from you. Otherwise, we'll see you next time on Hardman Talks.